Welcome to the Broken Pie Chart Podcast, episode number 56. I'm your host, Derek Moore, and today we're going to be getting into the risks of bonds in a low interest rate environment. You know, as another year came to an end, a lot of people talking about, hey, how did the 60-40, 60% equity, 40% bonds do? But also, at these interest rates, we're also seeing durations increase. And when durations increase, sensitivity to interest rates are there again. And recently, I've heard some talk on CNBC, on Bloomberg, Fox Business about, hey, are bonds overvalued? Are they undervalued? Is the end of the 60-40 portfolio near? And why is it that at such low rates, really, bonds, owning bonds take on some of the interest rate risk akin to the same thing of kind of short selling, where you've got unlimited risk to the upside, but limited gain to the downside. And I'm not saying that bonds are the same as, let's say, shorting a stock. We did an episode, of course, last week on the idea of the short selling, the mechanics behind it, what some of the terms mean around Tesla. But just bonds, when interest rates are this low, there's sort of a natural level that they can, at least rate-wise, they can go down to. And so when we look at the return of stocks versus bonds, we know last year was pretty good. It was, 2019 in stocks, the total return was around 31%. Of course, total return accounts for not only your return, but it also accounts for any dividends that get paid out and things like that. But also bonds had a pretty good year. And one of the proxies that we use to look at bonds, we can look at, let's say, the Bloomberg Barclays US Aggregate Bond Index. What does that mean? Well, the AGG, Apple, George, those probably aren't the right phonetic or words that are normally associated with those, but they work for me. The AGG last year was up about 8.68% on a total return basis. And we'll get into a little bit about what the AGG is, but just think of it, it's a U.S. bond index. It's basically the investment grade bond market, and it has any number of things. It has treasuries, it has corporate bonds, but its total return was 8.68%. And so you had stocks going up 31%. You had bonds going up 8.68%. Both really good years, especially considering how low interest rates are. But if we look at 2018, we had stocks down, somewhere around 5% or so on a total return basis, including dividends. Without dividends, it would have been down more. But in 2018, the AGG, the US Aggregate Bond Index, was actually down fractionally. It was down negative 0.05%. And so actually bonds did better than stocks, but neither had a positive total return in 2018. And that's one of the sort of the outlier things that happened in 2018, but also potentially could happen going forward. Not saying it will, but that's one of the risks out there that we'll talk about. And so 2018 was actually, from my memory, the first time that the aggregate bond index, the US Aggregate Bond Index, and stocks on a total return basis were actually negative in the same year. That normally is not the case. In fact, even if you go back to, let's say, 2008, 2009, when stocks were down, bonds were up, 5.75%, 5% respectively in those timeframes as well. So that's sort of one of the ways that you can look at that. Of course, the 60-40 portfolio, where you're thinking about 60% large cap equities, 40%, something like the AGG, that is one of those things that people feel like has worked for a long time. But there are some challenges in these low rate environments, and we'll get into those as well. So when we think about interest rates and bonds, and what's really the risk to bonds? Well, currently, as we record this, the 10-year Treasury bond was only about 1.58%, so I'll just call it just under 1.6%. That's come down a bit. I can remember in December of 2018, we had the 10-year, more hovering around the 3% range. And so rates have actually come down. But the risk in a bond is really tied directly to interest rates. And the reason why interest rates play such a big part in the price of a bond is that you've actually got, when you price a bond out, it comes down to the present value of all of its cash flows. And so bonds typically pay interest, twice a year on a semi-annual basis. Bonds also, their market value can go up or down prior to its maturity date, excluding defaults, meaning if it defaults, it can't pay its interest or the bond goes bad. But assuming no defaults, which is certainly a risk in bonds, you've got these bonds that are paying cash flows twice a year, and then at some point they mature, and they mature at par value. Par value means $1,000. So, when a bond comes out, it's issued theoretically at par at $1,000. It goes up or down in market value depending upon the amount of time until maturity and depending upon interest rates, but then it also pays these cash flows. So bonds, it seems it can be a little bit complicated in how it's compounded or how it's calculated, rather, should I say. But the reality is a bond is simply its price is a derivation of its present value of cash flows and present value of its price compared to what it will mature at. And so that's the reason why as interest rates go up, theoretically bond prices go down. As interest rates go down, bond prices go up. And so that's a major point or major source of the risk around bonds. So one of the components of what makes up the risk to bonds, it's not only when we say duration is really about the sensitivity to interest rates. And so think about it this way. Normally people think about, well, if I buy a 30-year bond, I have 30 years to duration. That's not actually true. Just like if you say, well, I buy a bond with 10 years to maturity, my duration's 10 years. The reason why that isn't true is because bonds pay cash flows, and they pay that via the coupon, twice a year. And those cash flows affect the sensitivity to interest rates. And so to think about this, if you buy a 10-year bond and you say, well, what theoretically would it go up or down for every 1% change in interest rates? You would want to know something about what's called the modified duration. Some people just call it, effective duration or duration. So to give an example on this, let's say you have a 10-year bond and its coupon rate is 10.39%. Why 10.39? Why not something else? I had it inputted in a spreadsheet that I'm going to tell you about. And the required return is 10.39%. And so the bond is priced at exactly par, $1,000. Why? Because it's not above $1,000, not below $1,000. Because your coupon rate, your annualized coupon rate, is exactly the same as the required amount of interest in the market right now. What's the market rate of interest for that duration of bond? So if you run, let's say, a modified duration, the modified duration in years is not 10, it's a little over 6. It's about 6.13. And so given a 1% move up or a 1% move down, you theoretically would expect around, a +6, -6 change. I mean, if interest rates went up, the bond price would go down. What's interesting, though, is that if we take that 10.39% rate of interest and we change it instead to a 1.5% coupon rate, 1.5% market rate of interest right now, bonds still trading at $1,000. We've got 10 years till maturity, same as the other one. But in this instance, the modified duration is over 9. It's about 9.25, 9.25. So that means unlike the prior bond, which is a little over 6, for every 1% up or down in interest rates, assuming the same about duration of 10 years, you would expect to make or lose, plus or minus 9%. The actual numbers work a little bit differently because you have something called convexity. It's beyond the scope of our broadcast today. And the reason why I bring this up is that when you have rates that are really low, that extends the duration, meaning your duration or your sensitivity to interest rates is a little bit closer to the actual maturity duration. And in fact, when you look at negative yield to maturity bonds in Europe, essentially those maturities or those sensitivities to interest rates on a duration basis are much closer, almost equal in many cases, pretty much equal to their actual duration. So if you have a 30-year bond with a negative yield to maturity, pretty much you've got a 30-year duration from an interest rate sensitivity standpoint. And that those calculations get a little bit crazier. So basically when you have a bond is, again, it's priced based upon its present value, discount future cash flows discounted down to the present, and future return of capital at maturity discounted down to the present. And you come up with a present value of the bond. And the lower the rates and the longer the maturity, the higher the duration or the sensitivity to interest rates. So what we're seeing now is bonds definitely have a higher duration, but they're paying lower rates. They're paying lower yields. So one of the things you can take a look at, if we go back to this AGG, it's actually the iShares, the core US Aggregate Bond ETF. Its average yield right now is a little bit over 2%. So 2% annual, excluding market value change. And remember what we just talked about of why market value would change. That's interest rate changing, going up or down. You'd expect to receive just above 2%. And the duration on this is a little bit under 6 years right now. And so that kind of tells you what the interest rate risk is of this portfolio. If you go up 1% in rates, assuming the same effective duration, you'd expect to lose just under 6% on that portfolio. And same thing if interest rates went down, you could make generally right about the effective duration. So that yield is pretty low right now. A fascinating thing to look at, though, and you can look at this in BNDX, Boy, Nancy, David, X-ray, and that's the Vanguard Total International Bond ETF. This one is based upon a global aggregate ex-US dollars, float adjusted. There's a bunch of terms in this. And basically, this is the AGG equivalent. If you wanted to look at the rest of the world, World Bond Fund ex-US, so there are no US bonds in there. And this one's annualized yield is only about 0.7% right now. So it's pretty low. And especially given where inflation is. So actually, you're on a real return basis, your yield to maturity on this one is below its negative real return. And its effective maturity or duration, let's say average duration, is about 8.1 years. So this one's interesting because you've got a number, I don't know the exact percentage of the portfolio, but a lot of these bonds are actually negative yielding to maturity bonds, meaning in theory, you give your money, you buy one of these, you'll get back less than you paid for right now, and your average and your yield to maturity is actually negative. So, and by the way, that I'll link to a whole episode I did on negative yielding bonds, and I think I actually termed it wacky negative yielding bonds, but there's reasons why people would buy them, and indices or products that hold, let's say, world bonds like this. They would be buying these, sometimes pensions. So I'll refer to that because I go into much more detail into that episode. So thinking back to the underlying thing is the risk of bonds, and why do you hear people saying bonds are overvalued? I'm not saying they are, they aren't. Look, people have been wrong about the direction of interest rates for many years. We know ever since post-crisis, 2008, 2009, the U.S. Federal Reserve Bank has kept interest rates very low. But people have been predicting the rise of rates or some normalization of rates, getting the 10-year Treasury closer to 5 or 6%, and it just hasn't happened. We've had lower rates. In fact, we have negative rates in places, most of Europe, developed Europe. We have negative rates in Japan, and that is below, obviously, the U.S. Treasury rates. So people have been wrong about the direction on this. I would say, I wouldn't make a prediction on what I think rates are going to do. But the purpose of this is just to understand that ever since 1981, May or April, March of 81, you actually could have bought not only a 10-year, but a 30-year U.S. Treasury bond yielding close to 15% annual rate of coupon. Imagine that. You buy one of those, you get a 15% a year. Still federal tax, but depending upon your state, I believe you get no state tax on that, no city tax. For the next 30 years, you could have gotten above historical nominal equity returns just on bonds. And the point of bringing that up is we had this high point of rates in March of 81 after the late 70s and the run-up in rates and the higher inflation. And literally for 35, 40 years now, we've had 30, I guess that's about 39 years now. Wow. 39 years, we've had a falling rate environment. And I just explained that as rates come down, bond prices go up. So if you're holding, let's say, a bond mutual fund every year, if you're rebalancing every year in, let's say, a 60-40 portfolio, the wind has been at your back for almost 40 years where falling rates have helped total returns of bonds, because not only do you get the coupon, which have been higher for many years than they are today, but you also get the change in market value. And so that's one of the reasons why people look at this current environment and say, although Europe has told us that there's no longer a zero bound floor, a 0% interest rate floor, they've gone negative. So who knows how negative they actually could be. But most people would say, well, I don't think we're going to see a change from positive 15 to, positive 1.5, the difference, let's say, in the 10-year over that time. Could we really see a difference of positive 1.5 to, negative 13% interest rates? And most people would agree that's probably not going to happen. But that's the reality of the monumental change that we've seen over that time. And so a lot of people point at bonds and say, there's only so much they could go negative. And remember, when interest rates go down, bond prices go up. And so a lot of people point to the fact that bonds right now have low yields, have low coupons, and that the marginal benefit of rates going down is a little bit limited because they can't really go, or they shouldn't go down that far negative. So in that regard, and there's actually been some other studies too, over the longer term when you hold bonds, theoretically you should average around what the coupon is. And so if you're holding the AGG and it's about 2%, or you're holding, let's say, US Treasuries, you buy Treasuries and the yield is about 1.5%, on an annualized basis over a long period, you should pretty much expect a return equal to around the coupon. And so that's one of the things that when people look at a 60-40 portfolio, they say, wait a second, I realize, I get the fact that I'm holding bonds, and in theory, if stocks are doing bad, and I'm holding treasuries with longer duration, that there should be a flight to quality, a place to hide out. But the holding cost of these, meaning what you get prior to that benefit, just isn't really that high. So that's one of the challenges there. The other thing to keep an eye on is, I said that convexity was beyond the scope of this conversation. It really is. It's quite complicated. But when we think about convexity is another way of saying, if I have a fund that's holding a bunch of bonds, in theory, if interest rates go down, will I see my duration go up or will it go down? And one of the things that a lot of funds have is they have what's called callable bonds. Callable bonds are simply, let's say you're XYZ Corporation or ABC Corporation, two completely fictitious corporations, right? But they issue a bond. They might put on there something of a call provision, meaning, let's say they issue a 20-year bond and they start to have call provisions maybe in year 3 or year 4, and they say, we can call it at par or some price above par. We can call that back in from the bond holders. And so let's say, they issue a bond at 7% and all of a sudden interest rates now in the market for same, U.S. corporate bonds, same credit rating, same duration, all that stuff are 3%. So the corporation says, thank you very much. I'll pay to, close out this bond, give the money back early, call in the bonds because I can change it from a 7% interest rate to a 3% interest rate and save some money there. So especially with lower interest rates, a lot more of the percentages of bonds are callable in portfolios. And you can generally, if you're holding an ETF, you're holding a mutual fund, you you can tell this. But I bring this up because what happens is, let's say that rates went way down, but you've got a bunch of callable bonds in your portfolio or in a fund that you're holding. What happens is the benefit, the market value gain benefit when interest rates go down is a little bit capped. Why is that? Well, because the corporations, if they have call provisions and they can reissue their bonds at much lower rates, they're actually going to call those in. And so they tend not to go up as much in value because they're priced to call, meaning, if they couldn't be called in, you would say, well, interest rates went down. You just told me it's the present value of the cash flows and the return of capital at par. But if we're pricing this like we get called back at its call price, so maybe its call price is 101, meaning 1,010 or 1,020, whatever it is, they tend to price more there. I bring that up, and it gets a little bit difficult to understand because she gets into convexity. Convexity is not easy, folks, especially if you haven't done a lot of calculations around bonds. But I bring this up because depending upon the type of portfolio, if you think interest rates are going to go down precipitously and you've got a bunch of callable bonds in there, you may or may not actually realize the benefit that you think you'll realize based upon that. So it gets a little bit complicated there, but it's worth bringing up. So back to the original question. Why is it people are saying that bonds are overvalued? Why are they saying they're undervalued? And why do people buy bonds at such low interest rates? Well, some funds obviously have to, if they're a bond fund, they buy these. But if you think interest rates are going to go down further, then you might think that the market values would increase. People who feel like interest rates can't go down materially on a percentage change basis like they have might say, look, interest rates would have to go really negative to get the same type of bang for your buck as you did all these years when rates were coming down from 50% on the US Treasury until now. And so that's part of the reasons why they look at that. They say durations are up, yields are down. And when you go back to the whole 60-40 portfolio where you're holding 60% in stocks, 40% in bonds, you start to think, well, is the juice worth the squeeze? Is the interest rates the coupons that you're getting, is it worth the duration risk or interest rate risk? And by the way, interest rates may stay where they are. They might go a little bit lower. And in that case, your bonds will do just fine as they did in 2019 when interest rates dropped from their levels of December of 2018 to where they were towards throughout 2019 when you saw, again, an up year in there. So just understand the risk of bonds and understand theoretically if you're holding bonds and you have sort of an average yield right now, what does that mean long term? And what are alternatives? And this is why we did an episode on sort of the myth of the 60-40 portfolio where we addressed a lot of alternatives to that classical 60-40 portfolio where you hold 60% stocks, 40% bonds, because there are alternatives and there's hedging that you can do and there's different strategies that will allow a little bit more equity exposure but limit the downside. So those are all interesting things to happen. I'm going to link to a bunch of episodes that I've done on negative yielding to maturity bonds, on the myth of the 60-40 portfolio, and another couple episodes that you might find interesting. By the way, before we go, I just ask everybody, rather than waste time rating and reviewing these episodes, go ahead and share this with somebody. Put it in an email, share it. Maybe somebody has not been exposed to podcasts before. Go ahead and do that if you think this is interesting and it might help some people. I'd prefer that you share it than rate it and review it and waste time doing that. And the other thing I would say is keep the emails coming. I'd love to hear from listeners. You can reach me at razorwealth.com and the contact icon. Go ahead and send me a note and let me know any ideas for future episodes. This episode today actually came from a listener who said, why are people saying that bonds are overvalued? What does that mean? So I thought it'd be a good episode to do. All right, everyone. Thanks for listening, and we'll talk to you again next week.